Good morning, everyone. Welcome to Officers. Good morning, everyone. Welcome to Officers Adda 24/7. My name is Niharika Walia Bhatnagar, and I am with you with the area of Advanced Business and Financial Management. Okay, so let's talk about the particular topic today. I'm going to talk about deal structuring and financial strategies. When we talk about the deal structuring and financial strategies, what kind of deals are we talking about? We are talking about one particular organization. See, I want to grow further. I am an Indian company and I can't enter the company which is outside India. So I decided I want to enter the US market. So what I did was I bought a particular organization in US and I'm trying to work over that. That is what we call in terms of deal structuring and financial strategies. So when we talk about this era, it is totally based upon the fact that we are looking forward towards buying another organization which is not in our area, but we still buy that organization because it can benefit us in such a way that if I try to enter that market directly, it won't work out. But if I enter that market through the other organization, it will definitely help me. So that is the kind of thing. So now we are talking about two different countries. When we talk about two different countries means two different ideologies. Two different ideologies means two different laws as well. And two different laws means if you are trying to enter that market, you have to know ignorance of law is no excuse. Specifically in our country, it is stated that if you say that I didn't know the law, that will not work out. So based upon this, here comes the first question. What is the purpose of bilateral? Bilateral means a particular thing, a particular contract which is made between two parties. Bilateral double taxation avoidance agreement, that is DTAA. When we talk about the DTAA, that is to increase tax revenue for both the countries involved, to limit the tax rights voluntarily and avoid overlapping tax claims, to encourage double taxation of income for cross-border transactions, or to impose the aggressive tax laws of the Indian setting. When we talk about the bilateral double taxation avoidance agreement. Double taxation avoidance agreement means if you are paying in India, the taxation is paid in India, then you are relieved from the taxation that is existing in the area of, for example, USA. Then if you have paid in India, then you don't have to pay there. So in this case, this really helps you to specify your income, and you will get relief if you are paying in India. Then you will get relief in USA. If you have paid in USA, then you will get relief in India. So basically for both the areas we are doing it. But we make sure that this is done to limit the taxing rights voluntarily and avoid overlapping of claims. That means if you have taken a claim in India, then you cannot take the same claim in USA. For example, I am in India and the same income is earned by the person. He has two places to work, so he is taxable in both the areas. So what happens is, in India he is paying tax. So in this case, since he has paid tax, this is availed in India. So this particular relief can be available in US as well, but he has to pay tax in India. So for USA, it will be a relief. For any tax which is paid in USA, he can claim a relief in India. But This should not happen, that I take a relief here and I take a relief here and no tax payment is there. So basically in terms of DTAA, they always ask that you provide us the details, what you have paid there and what you are paying here, to limit the taxing rights voluntarily and avoid overlapping tax claims. There should not be overlapping from both the sides. Okay? So this is what the first question talks about. Next question, why do most countries recognize double taxation as a disincentive for cross-border trade and activity? Because it encourages foreign investment, because it fosters healthy competition between the organizations, because it discourages cross-border trade and activity, or because it leads to a higher tax revenue. What would be the answer in this case, everyone? Why do most of the countries recognize? They recognize double taxation. Basically, now what happens is as a disincentive for cross-border trade and activity. This is something which doesn't really increases it, rather it has a major impact. See that when we are trying to have double taxation avoidance agreements now, there is a lot of formalities with it as well. You cannot avoid it. So when this happens, basic reason that they recognize it, they have to recognize DTAA. If they do not recognize DTAA, then the organizations will be involved in you can say exploitation of the other country, because you are not having any taxation agreements there. So there is a ambiguity in terms of where the country is paying and where they are not paying. So in this case, I would say it will, because they recognize it, so that they recognize it as a disincentive. It's something which is not really good for towards this, because this discourages the cross-border activity, because you have to give a lot of information in terms of DTA. It's not easy to go through the DTA, and the countries with which you do not have the preference there, the overall trading becomes challenging altogether. Right? Okay. Next question. It says, why is protection granted by a country with which India has a DTAA crucial in Indian setting? Because Indian tax administration is lenient, because Indian tax laws are clear and straightforward, because Indian tax administration is viewed as aggressive and the laws are ambiguous, because India does not have any tax concerns in cross-border. Why is protection granted by a country with which India has a specific point there? What would be the answer, everyone? Overall, now the protection granted is basically very crucial for the Indian setting, because now Indian tax laws are very aggressive and the laws are basically ambiguous as well. So this protection is definitely required. Otherwise, sometimes it becomes very difficult for the Indian companies to understand it as well. So for foreign companies, it's another level of trouble. Okay? So the answer would be, because Indian tax administration is viewed as aggressive and laws are ambiguous. There are so many loopholes. So then it is definitely required that to have a protection against this scenario. Right? Moving on to the next point. Here comes the next point, that is, which countries accounted for more than 50% of the FDI in India? China, Japan and South Korea, US, UK and Canada, Mauritius, Singapore and Cyprus, or Australia, New Zealand and Germany? Which countries have more than 50% of all FDIs in India? What would be the answer? More than 50% are of Mauritius, Singapore as well as Cyprus. Okay? All these three countries, Mauritius, Singapore as well as Cyprus. When we talk about Singapore, Singapore is a country which has made itself whatever it is through the FDIs only. It didn't have its own money, so it asked other countries to come and build things for them and earn this from this particular infrastructure which they created, and then they can leave. So in this case, what would happen is, if you prepare a particular infrastructure in my country, even if if both the countries are having a particular dispute, then even you will not fight with me over the fact that I'll take my infrastructure back. You cannot. So in any case, you ask the top-notch countries to come to your country, prepare something for you, earn through that, and then they can go. So you don't have to face a lot of problems, but you just have to make sure you don't get colonized. That's the point. I'm sorry. So here comes the next question. It says, which is one of the key factors that can drive in terms of or impede cross-border transactions? Availability of DTA, aggressive tax administrations in both areas, complex legal procedures, or high transportation costs, which can either drive or impede. What is the thing that will really make our cross-border transactions, double taxation avoidance agreements in a better way, which is basically something that helps in cross-border transactions? DTA. When the DTA is available, people are able to pay, because normally what would happen is, I am paying tax in India, I am paying tax in US, and there is double taxation on me at all the times. This is very, very difficult for me to do that. So what I'll do is, I'll ask them, ki sir, one thing that you can do is, if I pay tax in India, why don't you recognize it? If I pay tax in US, why don't you recognize India? So in this case, I can ask any of the companies to, any of the countries to recognize it, and they will. So in this case, there would be greater chance of me to do cross-border transactions. Otherwise, I'm thinking about the fact I have to pay tax in both the areas, work in that way in both the areas. That can be problematic, no? So the answer is availability of DTAA benefits. Next question. Why do current accounting standards mandate recording 100% of the assets bought in and the liabilities assumed, even if the acquirer buys less than 100% of the target? They are saying that even if it is less than 100%, if it is more than 50%, then you record the entire 100% in it. So they are asking, why do we do this? To overstate the value of the acquisition, to facilitate the comparison across the various transactions, to obscure the financial statements, or to avoid recognition of the non-controlling interests. See, this is a mandate because now in this case you want to make sure that the comparisons are easier. Otherwise, it becomes very difficult to compare if one organization is at 70%, one is at 100%. How will you compare all the industries in that particular industry? How many companies are there and how do you compare them? There should be something in which you can actually make the comparison easier. So you have a specific rule, make it up to 100% there, show it in your books of accounts so that we can compare different companies in that specific industry who are working. Next question, what must the buyer account for in relation to the non-controlling interest when acquiring a target? There is a controlling interest where you have the power there, and there is non-controlling, only the goodwill attributable to it, or only the non-controlling interest liabilities, both goodwill and goodwill attributable to it and non-controlling interest, or neither goodwill or non-controlling interest. See, one is minority and majority. So the one who has the controlling area is controlling interest. They have more than 51% in that particular company. And if they do not have it, then it would be covered in this area. So what would be the relationship there? In this case, what must the buyer account? The buyer should account, see, when we are talking about 100%, that means you are taking all of it, isn't it? So in this case, the answer will come out to be both the goodwill attributable to it and the non-controlling interest. Both would be covered here. Done? Moving on to the next question. The next question says, where is the non-controlling or minority interest shown in the consolidated balance sheet? Do we show it or not even? See, because if I prepare a particular balance sheet, then where do we record these things? We have to look into the matter now. It is combined with the parent's equity. It is shown separately from the parent's equity, or it is excluded from the balance sheet, or it is recorded as a liability. What would you do in this case? Where is the non-controlling or minority interest shown in the consolidated balance sheet? when we talk about the non-controlling or minority interest, this would be basically shown separately in the parent's equity. It has to be shown that there is two things. One is controlling, that is their majority, as well as non-controlling, which is minority. Both the things have to be shown. This is majority, the one which has more than 51%, and the one which is less than that, that is minority. Done. Moving on to the next question. It says, when a firm A needs to record its shareholders' equity if it purchases 50.1% of B. 50.1% means now you are above 50%. If you are above 50%, you are a controlling majority, because whatever you say, everything is going to happen according to you. Because you have 50.1, the other one will have 49.9. So you have greater authority over the entire scenario. So it's gonna be 50.1% of the firm's net income, 100% of the assets and liabilities would be shown, or 49.9 of the B's earnings, or 100% of the assets of B. In this case, we are going to show the entire 100% of the entire company that has to be shown there. So in this case, it is 100% of the assets and liabilities of the firm B it has acquired and assumed. Because you are the controlling majority now. You are the one who has a greater control over this organization. Your control has to be specified. So can I say that when we talk about controlling, and when I talk about non-controlling, what are the differences that are occurring? This is more than 50%, more than 50%, and this is less than 50%. If you have more than 50%, you would always show the 100% of it, so that you can actually show what is happening in the organization. Okay? So this would be shown in your balance sheet as 100% to make sure the comparisons are easier, just for the comparison sake. Okay? And then while if it is less than that, then it is called non-controlling. Done? You can note this point down. Now let's move on and talk about the next question. Now let's look at this question. It says, why is foreign owned and controlled company unable to obtain acquisition financing from Indian banks or Indian financial institutions? There are certain organizations which are not Indian. They are called FOCC. That is foreign owned and controlled. They are owning it, and as well as they are controlling it as well. So in this case, FOCCs are not allowed to engage in acquisitions in India. No, this is not that. FOCC are prohibited from using leverage in India. Indian banks and financial institutions do not provide foreign financing for foreign owned companies, or FOCCs are not allowed to issue debt for acquisitions. Basically now what happens is these FOCCs try to find an Indian company, they try to merge with them, or they try to work with them, because ultimately now the Indian companies or the domestic company will always have an upper edge over the ones which are not. Right? So when we talk about Indian companies, they will always have an upper hand over this area rather than the foreign companies. So in this case, what will happen is these organizations, they do not have a lot of help from the country. That means the FOCs are prohibited from using leverage in Indian market. Matlab, they cannot raise money through the debt in Indian market. For this, what they do is, these FOCCs, they try to have a JV, joint venture with Indian companies, or they have a special purpose vehicle. They acquire a domestic company. They look forward towards mergers. They look forward towards acquisitions. They look towards all those areas in an organization so that they can actually earn more. because for that they need the Indian market. They need the growth in the Indian market. They need to have access in the Indian market, debt and equity. They need to have someone who is listed on the Indian stock exchanges as well. So in that case, raising money will not be a problem to them, because till the time they are foreign owned, their working in India is definitely restricted, right? That is why deal structuring is super important. Okay, here comes the next question. When we talk about foreign owned and controlled company, what form does the debt needed to finance an acquisition through an FOCC typically take? Equity shares, then non-convertible debentures, then comes government bonds and preferred stock. See, this market is definitely not accessible to them. This market is just not accessible. When we talk about equity and preference shares, this is not. Government bonds, again very difficult. So they are raising money through the NCDs, non-convertible debentures, the debentures which cannot be converted into any other form. Otherwise, in our country, we also issue convertible debentures. Convertible debentures are those debentures which can be converted into equity, which can be converted into any other form altogether. Okay? So in this case, this would be convertible debentures or equity or any other form which they would specify. So non-convertible debentures are the forms which cannot be converted into any other form. So this is how the FOCCs are raising money for themselves in our country, because it is very difficult to do that. When we talk about how an Indian company finance an outbound acquisition using onshore financing. Outbound means I decided to go to US in terms of growth. Now I need someone, I need leverage so that I can go to USA, so that I can buy some shares in USA and I can grow further in USA. That is what I would want, isn't it? I don't want to grow in India. Because inbound is, there are two kinds of these things. I think let's just get through the answer and then I'll show you what kind of the acquisitions are there. How an Indian company finance an outbound: by sharing equity shares, by raising loans from equity, loans from Indian banks, by issuing government bonds, by securing loans from foreign banks. Foreign banks are not going to help us. Ultimately, we are going to raise our money through the Indian banks. Indian banks are our area, na? Okay, let me talk about inbound and outbound. Inbound as well as outbound. Okay, I'm talking about the outbound acquisition for onshore financing. I'll talk about onshore as well. So inbound acquisition is when an Indian company is acquired by a foreign company. This company is trying to broaden up its horizon in India, so they are trying to buy an Indian company. When we talk about outbound acquisitions, under this what happens is, whatever our Indian company is basically going out and trying to buy a foreign company. Onshore financing is, I am getting financing from India. Okay, I need money there, but to buy some organization which is outside India, I am going to use money from India. So I'll get some bank in India, and from that bank I'll get money, and then I'll buy the foreign company. Okay, this is inbound and outbound acquisitions. Got the idea, everyone? This is simple finance, but the point is the techniques that they have specified, the kind of language which they have used. It is quite crazy. That is what I can say. Done, everyone? Chaliye, one more question to go and then we will end the session. Let's move on. This is the question, that is external commercial borrowings, where what is ECB commonly used for the context of outbound acquisitions. What kind of ECBs are used in terms of outbound? Matlab, we are going out and trying to buy some organization outside India. Financing domestic acquisition in India, purchasing shares of overseas joint ventures or wholly owned subsidiaries, issuing NCDs to domestic mutual funds, or establishing offshore special purpose vehicle. SPVs are basically now, if I have to buy some organization outside. You know about what do people do when okay, it's an illegal thing, so, but let's talk about it. It's one of the easiest way. You've heard about the word supari. If I want, I don't want to kill someone. So what I do is I give money as an extortion to someone that I want this particular person to be killed. I don't want my name in that. So in the initial period, matlab SPVs are like this. In the initial period, there is no need to tell my name. Ultimately, I will take over the body of that particular person. Sounds weird, but let me tell you how it works. What happens is, I'm the main company. I want to buy some other company. So in this case, it is not possible to reach out to that company directly. So I make a special purpose vehicle. It can be special purpose acquisition company, which is buying all the shares of this company. Once it has got the entire company's control, this company will dissolve itself and I will get the entire company. So this is just doing my work. So special purpose vehicle can be built to manage the assets, to buy some other company. There are specific purposes for which these organizations work. Right? So in this case, what would be the answer? If we talk about external commercial borrowings, it is purchasing the shares of the joint venture. This is one of the best ways. You have a joint venture with the other company. It is like purchasing shares of the overseas joint ventures or wholly owned subsidiaries. You try to develop yourself through JVs or having subsidiaries there. This is a better way where you can grow in the other company, in the other countries. For example, Domino's is not working in our country on its own. It is working through Jubilant Foodworks Limited. Both of them have a joint venture in India. They don't have to work in India, Domino's altogether. It is working through this organization. This happens. So JVs or joint ventures or having subsidiaries makes it easier to go and commence your business in other countries, which individually going to that particular country would have been quite difficult. Okay, so that's it for the day. Okay, before we end the session, let's discuss our specific goal. If I look forward towards our website there, let's look at this, everyone. When we talk about our website, if you just go to the area of adda247.com, right? So when we go to the website adda247.com, there you will find all the details regarding CAIIB. The kind of topics that are there in ABFM, they're quite difficult, and you are looking forward towards mentorship, then you shouldn't really wait a lot of time. It is very difficult in terms of covering the syllabus just at the end. So you have to go on to the area of JIB and CAIIB, go on to the area of JIB as well as CAIIB. There it is given JIB November. ABFM examination would be conducted in December. That means you have ample of time. You don't have to rush through the syllabus, ki nahi, I have to cram it up. You can actually understand the syllabus in proper detail. So what do you do in this area? You go through our website, you will find our Sankalp batches. English medium batches are here. You just have to click on CAIIB Mahapack 2.0. In the CAIIB Mahapack 2.0, as soon as you click on it, you will find that the courses are available at 7367.40. That means 81% discount is going on. Plus at the same time, Navratri has started. So on the first day of Navratri, throughout the Navratri, I believe you will be having a specific discount, but this discount is for a very limited period. You need to keep an eye when the particular sale is ending. It is currently available at 81% discount, and that too at double validity. You just have to use the code NAV80, right? So there is a 3-month pack. There is no double validity on that. If you go for 6 months, this month 3-month pack is for 5,000. 6 plus 6, it is for 12 months. So when we talk about 12 months, this would be available for you for 7367. And if you're looking forward towards 12-month pack, which would be available for you for the next 2 years, right? It would be that is 10,314.40. This includes everything. After this Mahapack, you don't have to pay even a single penny. The revision batches, the regular batches, both bilingual and English medium. My previous batches, the current batches, the upcoming batches, everything would be available in this. Plus, the ebooks are available, mock tests are available. Then you can also go through the previous Maha marathons, mega marathons. Every marathon would be available in this area. Plus, along with this, in this area, we are also providing you doubt classes on 2nd and 4th Saturday. Practice papers are also given to you. Then we are trying to give maximum MCQs for practice as well. So all these things are available in this specific Mahapack. So if you're looking forward to it, so kindly check it out on our website, on our app. And individually it is also available, but in Mahapack you will also get all the optional subjects. So whatever your optional subject is, be it the 5 elective, rural banking, HRM, IT and banking, risk management, central banking, all these are available. So you can check it out on our website or in our app for further details. So that's it for the day, everyone. I'll be meeting you on the next day, that is tomorrow at 8:30. Thank you and keep on studying. Bye bye.